Listen, I have to be straight with you about something that's been blowing up my feed. Trump just floated this idea of a 50-year mortgage, and people are actually getting excited about it. And I'm going to tell you right now, this is one of the worst ideas that I've heard in a long time. And here's exactly why. Look, I get it. Housing's expensive. People are desperate for solutions. Mortgage rates are still sitting around 6 or 7%. Home prices are through the roof. And first-time homebuyers are getting completely priced out of the market. So when someone comes along and says, "Hey, what if we just stretch out your payment over the next 50 years instead of 30?" I understand why that sounds appealing on the surface. But a 50-year mortgage? Not the solution. That's a trap dressed up like an opportunity. And I'm going to show you exactly why with the actual numbers, because once you see the math, you will realize that this makes absolutely no sense for anyone. First, let me give you some context. The 30-year mortgage wasn't always the standard. It was actually created back in the 1940s after World War II as a way to help finance the construction and sale of new homes. Before that, most mortgages were short term, like 5 to 10 years, and they often had balloon payments at the end that would wipe people out. By the end of the 1950s, the 30-year mortgage became the gold standard because it gave families a way to build long term equity without getting crushed by a massive payment. And today, more than 90% of homeowners choose the 30-year term. It's seen as the safest option, fixed payments, predictable costs, and you know exactly what you're getting into. Now, there's other options out there. You've got 15-year mortgages, adjustable rate mortgages, interest-only loans, all kinds of products. But the 30-year fixed rate mortgage dominates because it offers the most flexibility and stability for the average person. So let me break down the math for you, because this is where it gets really interesting. When you go from a 15-year to a 30-year mortgage, you improve your buying power by about 34%. That's significant. That's real money. That's the difference between qualifying for a $500,000 house versus a $670,000 house. But here's the kicker. When you stretch from a 30 to a 50-year, you're only improving your affordability by less than 8%. 8% for doubling your loan term. Think about that for a second. You're signing up to be in debt for 2 more decades, and you're barely saving anything on your monthly payment. Let me show you the actual numbers so you can see how insane it is. Let's say you're buying a $500,000 house with 10% down. That means that you're financing $450,000. With a 30-year mortgage at 6% interest, your monthly payment is about $2,700. Over 30 years, you'll pay roughly $970,000 total. That's $520,000 in interest alone. Now, with a 50-year mortgage, and here's the thing, they're going to charge you more interest because it's a riskier loan. Let's say 7%. Your monthly payment drops to about $2,530. So you save $170 a month. That's it. But over 50 years, you'll pay $1,518,000 total. That's over $1 million in interest. So you're saving less than $200 a month, but you're paying an extra $500,000 over the life of the loan. Does that sound like a good deal to you? Because it sure doesn't to me. And here's the thing. Even if they offered you the same 6% rate on a 50-year mortgage, which is mathematically impossible, by the way, your payment would only drop to about $2,630. You're still barely saving anything. And here's what nobody's talking about. The way mortgages work, your payments are front-loaded with interest. So in the beginning, you're basically just paying the bank. You're not building equity. Let me show you what I mean. With a 30-year mortgage, most people sell their homes after about 12 years. That's the national average. And by that point, they've built up some decent equity. Maybe they paid down $80,000 to $100,000 in principal, plus whatever appreciation they've gained. But with a 50-year mortgage, after 12 years, you've paid off maybe $32,000 in principal. That's it. The rest has all gone to interest. So let's run through a real scenario. You buy a house for $550,000. You put down 10%. That's $55,000. You finance $495,000 on a 50-year mortgage. 12 years later, life happens, you get a new job, your family grows, whatever, you need to sell. Let's say the house is worth the exact same. So $550,000, the same price you paid for it. No appreciation, no depreciation, just flat. You sell the house. After a 6% commission to the real estate agents, you're paying $33,000 in your closing costs. You still owe $463,000 on your mortgage because you barely paid down the principal. So you walk away with $54,000. You put down $55,000. You literally lost money for the privilege of owning a home for over a decade. And that's assuming that the market stayed flat. If the market dropped even 5%, you're completely underwater. And here's another problem. Banks don't even want this. And let me explain why. A 30-year mortgage works because it's tied to the 10-year treasury yield. That's the benchmark. Investors understand that risk. They know that most people will refinance or sell within 10 years. So the actual duration of that loan is much shorter than 30 years. And that's why the secondary mortgage markets work. Investors can buy and sell these loans with confidence. But a 50-year loan, that's a nightmare for anyone holding that debt. And here's why. If interest rates drop, the borrower refinances and the bank loses the loan. They're stuck with whatever they paid for it on the secondary market, and now they can't collect that higher interest anymore. But if interest rates go up, the bank is stuck with a low yield investment for half a century. They're locked into a 7% return when they could be getting 10 or 12% on new loan. Nobody wins. And here's the legal problem. By law, a qualified mortgage can't exceed 30 years. These qualified mortgages are really important because they protect both the lender and the borrower. They give the lender resources if the borrower defaults, which means that they can charge lower interest rates because the risk is lower. A 50-year mortgage would have to be non-qualified, which means higher risk, which means higher interest rates, which completely defeats the purpose. You'd probably be looking at 8, 9, maybe even 10% interest on a 50-year loan. At that point, your monthly payment might actually even be higher than a 30-year mortgage. Look, if this actually happens, it's probably going to be some niche product offered by developers who just bake the extra cost into the purchase price. It is not going to be this widespread solution that people think it is. And honestly, it shouldn't be. You want to know what would actually help the housing market? I have 3 real solutions that would make an immediate difference. Solution number 1, increase the capital gains exclusion. Right now, if you're a married couple and you sell your primary residence, you can exclude up to $500,000 in gains from capital gains tax. That limit was set back in 1997. If you adjust that for inflation, you should be closer to $1 million today. So here's what we do. Increase it to $1 million for married couples, $500,000 for single filers, and then adjust it every year for inflation going forward. This would incentivize way more sellers to list their homes because they wouldn't be hit with a massive tax bill. More inventory means more options for buyers, which means lower prices. Solution number 2, let people take their mortgage rates with them. This is a big one. Right now, if you bought your house in 2020 or 2021, you're probably locked in a rate around 3%. If you want to move right now, you're looking at 6 or 7% on your new mortgage. So what do people do? They stay put. They don't list their homes. And that creates the massive inventory shortage. What if we let people take their existing rates with them when they buy their next primary residence? You bought at 3%, you get to keep that 3% on your next house, as long as you're trading up. That would unlock a ton of lower price inventory because people wouldn't feel trapped in their current home. Solution number 3, expand the mortgage interest deduction. Right now, you can deduct mortgage interest on loans up to $750,000, but only if you itemize. And with the standard deduction being so high now, most people don't itemize anymore. So here's what we do. Allow people to write off up to $1.5 million in mortgage interest, but only for new loans issued after 2026. This creates an incentive for people to buy new homes, which stimulates the market, increases inventory turnover, and helps builders stay active. These are real solutions. A 50-year mortgage is just a gimmick that sounds good on Twitter, but falls apart the second you run the numbers. The bottom line is the average home buyer in America is 40 years old. You really want them paying off their house till they're 90? Come on, that's not building wealth. That's just being in debt for your entire life. And here's the thing. I'm not trying to be negative here. I'm not trying to rain on anyone's parade. This isn't about politics. This is about understanding the math and not falling for something that sounds helpful but actually makes your situation worse. Housing affordability is a real problem. I see it every single day. I talk to people who are struggling to get into their first home, who are watching prices climb further and further out of reach. I get it. The frustration is real. But a 50-year mortgage isn't going to fix that. It's going to make it worse. It's going to trap people in debt for longer, cost them more money in the long run, and create a whole new set of problems that we haven't even thought about yet. If you want to build real wealth through real estate, you need to focus on buying properties that make sense in markets that have both cash flow and appreciation potential with loan terms that actually work in your favor. A 50-year mortgage does none of those things. So that's my take. I know some people are going to disagree with me. I know some people are going to say, well, at least it's something. But I'm telling you, this is not the answer. Let me know what you guys think of the 50-year mortgage in the comments down below. Do you agree with me? Do you think I'm completely wrong? I want to hear from you. And if you want to learn about investing in real estate the right way, how I built $1 million portfolio by the time I was 28, make sure you subscribe. I'm making new videos every single week, breaking down exactly what works and what doesn't in today's market. As always, guys, thanks for watching, and I'll see you on the next one.